Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Victor Manasce to the show. Thank you for coming on, Victor. I appreciate your time today.
Great to be here.
Awesome. Thank you, Victor. So for viewers and listeners, Victor is a veteran in the industry. He has done a lot of work as far as construction and syndicated assets go. Originally, through the professional career in the semiconductor industry, he has a varied background through that, and he decided to jump into real estate. So in your own words, Victor, give us your bio as to, sort of your experiences in your professional industry and how you came around into full-fledged into real estate for that matter.
Well, certainly my path into the world of real estate investing and development was probably not the typical career path. I started my career as a microprocessor designer, trained as an electrical engineer, building processors for telecom applications initially, and then increasingly for a very wide array of applications. So, for example, I've got some of the support chips that sit around a microprocessor in all kinds of applications, everything from Hewlett-Packard storage networks to Brocade fiber channel switches to I've even got a chip in the Patriot missile. I mean, I've got chips in all kinds of hundreds and hundreds of different applications. If you've flown, for example, on an Airbus aircraft, the seat back display that shows the movies, that's made by a French company called Thales, and that's the Thales 4400 system with my microprocessor in it. So again, just hundreds and hundreds of applications all over the world. Mm-hmm. And around 2008, 2009, I was working on building a new cellular network in Japan with a carrier there, and I was traveling back and forth to Tokyo every couple of weeks, and it was burning me out physically, emotionally. And we were, of course, in the midst of the post-2008 economic meltdown in the U.S., sure. Mm-hmm. And I saw really an opportunity of a lifetime. I said, let me get out of this and go do something different. And I took a hard left turn and got into the world of real estate investing on a full-time basis back in 2009.
Interesting. Now, going from such a high-tech career, Victor, all the way into real estate, how was that sort of the hard left transition as you described? Was that through perhaps doing some little bit of real estate, maybe like fixing up houses or doing some of that work initially, or you kind of maybe took on a mentor and you try to get into construction as you are now? How did that come about?
I started out doing smaller projects, and I kind of started at the bottom like a lot of people do. Mm-hmm. And I didn't take a real estate approach to things. I took more of a business approach. So the very first project I did, I live in Ottawa, Canada, our nation's capital, and we have a number of folks coming through the city that are on a temporary basis, parliamentary staff, embassy staff, military officers, and so on. Sure. And this was in the days before Airbnb. So what they needed was a fully furnished turnkey apartment within walking distance of Parliament. Sure. That met their housing allowance. Mm-hmm. Mm-hmm. They could go to a sweet hotel and spend $3,500 a month, but that was well above their housing allowance. Sure. So if I knew what the price point was, I knew what the answer was, and if I could deliver a product at that price point, then I had a very good business, and that's where I started. Sure. So it was a very pragmatic, very practical approach. Now, that was a good business. That wasn't a great business. Mm-hmm. Mm-hmm. And then post-2009, I saw much more opportunity in the U.S. to buy properties at far below construction cost, and that's where I turned my focus. So we didn't start out building, because it didn't make any sense. You could buy things below construction cost.
Sure.
Right? And it took...
And I agree with your sentiment there, Victor, as you were saying that I think you can reverse engineer what the end product would be, and then kind of try to focus your strategy or devise a methodology to deliver that. I think that gives you, and I think your comment about in the post 2008 09, that recession, I mean, the market was so sort of messed up at the time that, I mean, you could see you can buy assets well below construction costs. I can echo that sentiment for sure.
Right. Right.
But go ahead with your thought, what you were saying, Victor.
So, fast forward a few years, we ended up buying a number of properties in bulk. We started doing some work in Chicago on the south side. That didn't turn out to be the best move, because one of the things that I learned in the process is that your clients actually have the money.
Mm-hmm.
And if you're to accumulate wealth, the money has to transfer from them to you.
Sure. Mm-hmm.
But if your clients are broke, then the whole system breaks down.
Sure.
So if you go into neighborhoods that are economically depressed, and there just isn't the income and jobs in those neighborhoods to support it, yes, the properties are cheap and they look good in a spreadsheet, but they don't look so great in real life.
Sure.
So we started moving up market. We started finding opportunities in Philadelphia, developed some very strong relationships there, and developed a strategy that we call buy on the line, move the line.
Mm-hmm. Mm-hmm.
And that line exists in every city in America.
Sure. Mm-hmm.
It's that line between the hot neighborhood with the coffee shops and the art galleries, and you go 2 blocks too far and you're in the hood.
Sure. Mm-hmm. Mm-hmm.
So when you find those situations, if you buy properties distressed on the wrong side of the line, assuming that line is arbitrary,
Sure.
if the line's a municipal boundary, if it's a freeway or a railway line, that's a harder line to move. But in a lot of cases, that line is arbitrary.
Sure.
And just for whatever reason, this block has been really rough and this other block, a block away has been really nice.
Sure.
You can move that line by redeveloping on the wrong side of the line.
Couldn't agree more. And I think the key aspect, as you said, is that buying that sort of on the line and moving the line requires some scale. As we are speaking here, this is not something, hey, you're buying 1 or 2 houses. This is a major development that you would do so that you create that impact and you pretty much move the line, as you call it. I like that term. Never heard of them saying that, buy on the line or buy the line and move the line. So what is your experience, Victor? I think I also echo that comment where you said that your end consumer or your end tenant, for that matter, if the city and hence the whole economic depression around that area is there, it's not going to be a great investment for not only for you but for the entire team of investors and things like that, right? So speaking of that, Victor, what were your challenges? Like, meaning, how did you come out of it, and perhaps how did that focus shift into what you are doing today, for example?
My focus today is on doing projects with the very best people always, because it doesn't matter how good a deal you have on paper. A good deal poorly managed, of course, is no deal.
Sure.
So the only differentiator in that equation is not the deal, but the management. And what's the caliber of the people that are on your team. And so I'm always looking to upgrade relationships, to bring stronger people into the team. If something's not working, one of 2 things: you maybe have the wrong person in the wrong chair, or we have a particular function that should be staffed and isn't. Almost all problems can be traced down to one of those couple of root causes. If you say, well, nobody checked the quality on this particular item, you say, well, whose job was it to check the quality? And if nobody puts up their hand, you found the problem.
Sure.
Right. Or if someone says, well, it's everyone's responsibility. Well, that's nobody's responsibility.
Right. That's too vague at that point.
So it has to be, you have to be able to point to say, okay, that person, that's their job. And okay, maybe they messed up, and you can have a conversation around that, but at least it's clear where the responsibility lies and you can remediate the issue.
Sure. Right. Now, Victor, coming to some of the tangibles, for example, you are let's say an electrical engineer deeply into semiconductor industry and things like that. Now, when you make the shift into construction industry, what were some of the key, people that you surrounded with, or perhaps what are some of the key alliances one should have if we were to, look into, let's say, going into construction aspect of the business, what are some of your experiences that give me like give us some like, maybe top 4 or 5 things that you have to have. And perhaps another thing on the same token, Victor, would be is that, let's say you move into a new area, maybe I'll take that question after you answer the first one,
Well,
perhaps.
here's the thing. If I could do what I want to do without having to build new, I would rather do that.
Sure.
Okay. Um, Almost everyone who goes into construction does that as a last resort because there's more risk, there's more work, there's a lot more moving parts. It's more difficult, it's more time consuming. It has the advantage, though, that in today's environment where there's too much money chasing too few opportunities, I mean, think about it. If a 400 unit apartment complex comes on the open market today, there'll be a dozen bids or 20 bids on that project.
Sure.
If you're the winning bidder, you're almost guaranteed to pay too much.
Sure.
So I want to get out of that auction environment. And the best way to get out of that auction environment is to be a bidder of one. And the only way you're a bidder of one is if you're competing with other people for an idea that's strictly in your own mind and is not out there on the internet saying, I'm a deal, come and get me.
Sure, sure, sure. And it almost goes back to the thesis that, hey, as you pretty much described it, this is the same exact conversation I was having with few of our partners, saying if there is a B or C class deal, there are hundreds of people, trying to get in the door. But if we are looking at a sort of a new construction development, there's perhaps only a very few subset of people who are looking at it, and perhaps that's our distinguishing factor that you can go in and do what you want to do. But going back to some of these things, Victor, when you look at it from a team standpoint,
Yep.
what are some of the key relations you find that you have to have?
Number one, you've got to have outstanding capital partners. You've got to have people with very good construction experience. When a lender is going to lend you, I don't know, pick a number, $30 million
Sure.
for a construction loan, they want to know, if you mess up, yeah, you might sign a personal guarantee, and we'd rather even not do that. They might come after you personally, but if their money is most secure, not based on anyone's balance sheet, but based on someone's track record and experience
Sure.
managing projects of that type. So they want to know that the people that are doing this have that experience.
Sure.
For example, a project that I'm doing here in Ottawa, Canada, one of my partners on this project is one of the premier builders in our home city. He's built thousands and thousands of units. My partner on a lot of these U.S. projects has built 10,000 units so far in his career.
Sure.
It's going to take a little while for me to catch up to him.
Sure. Sure. Sure.
So when the lender says, well, show us your development resume. Well, I push his resume to the front.
Sure. Sure.
So that makes all the difference.
Awesome. It's the power of the team that pushes the whole team forward.
Absolutely.
For sure. Awesome. Now, speaking of, the project specifics, Victor, for example, what are some of the things you look for in a sort of in an asset? Let's start with, what that sub-market looks like, and then what are some of the elements that you look for on a site, I should say, that kind of start to appeal you and say that, hey, this might be something interesting that we could take a further look at it.
I'm looking for demographics. I'm looking for jobs. I'm looking for population growth. So, for example, I want cities that are experiencing that influx of population for a variety of reasons. I want to see the draw of employment for sure. I want to see a mismatch between demand and supply, more demand than supply. Sure. And I want to see things that are holding back the supply, because eventually, in any attractive market, it'll get oversupplied. We've seen it in Seattle. We've seen it in New York City. We've seen it in Miami a couple of times. Money starts chasing these opportunities and gets ahead of itself.
Sure.
So you don't want to end up on the wrong side of history with that situation. So you want that mismatch between demand and supply. You want strong fundamentals. You want to make sure that there's a margin, a profit margin. If you can build at, say, today, $130 a square foot, that you can sell that in the open market for double that.
Sure.
Or or get it valued at something substantially
Closer
above
to that. Right.
right?
Right.
So you're looking for all those fundamentals,
Mm-hmm.
and if they're not there, if even one of them is missing, you don't do it.
Mm-hmm. Interesting. Now, on the similar topic, Victor, uh, how do you control some of the risk in that? Like, you have sort of a, let's pick a number. Like, you have a project that spans for, let's say, 2 year as far as 18 months to a couple of years as far as the core construction goes. What are some of the top risks in your mind that you're kind of weighing as you execute some of these projects?
Oh, how much time do we have?
That will be a podcast in itself, yes.
Yeah, there's obviously a number of things that can happen. I mean, who would have predicted that we would be facing a global pandemic?
Oh,
And
sure. Mhm.
so in 2020 and 2021, most people have a much more sanguine perspective on risk than they might have 2 years earlier,
Sure.
where they said, no, the economy's going gangbusters.
True.
Unemployment's at 5% and everything, the world is
We are
great,
just going to fly.
right? Exactly. So 2020's taught everybody an awful lot about even some of the things that can go wrong, even in an otherwise safe environment.
Sure. Mhm.
Countering that, of course, we have still a tremendous amount of liquidity in the market,
Mhm.
a lot of cash available. The thing where people get into trouble is if they have projects that are undercapitalized,
Mhm. Mhm.
and nothing wrong with the project, they just ran out of cash because they didn't budget properly.
Sure.
That's
Mhm.
hard to fix
Sure. Sure.
unless you recapitalize a project. You can have economic situations change.
Mhm.
If you are in a community that is heavily tied to, let's say, the price of a particular commodity,
Mhm.
copper, gold, oil, whatever,
Mhm.
and that community lives and dies on the price of that commodity, well, you've got some risk,
Sure. Sure.
right?
It's a
So,
one-trick pony that can go dead real quick.
yeah, exactly. So for example, would I invest in certain smaller communities in North Dakota?
Sure. Mhm.
Probably not,
Right. Right. Right.
because they're very much upstream and they're sensitive to the price of crude oil.
Sure.
Would
Mhm.
I do something in the energy corridor along the Gulf Coast where it's all midstream and downstream, refining, distribution, and all the rest? That feels safer to me.
Mhm. Mhm.
So it all depends. You just got to look at those economic fundamentals, and of course, real estate as always is hyper local,
Absolutely.
right?
Absolutely. Now, speaking of these projects, Victor, do you typically go with land development from ground up, or meaning you're acquiring a blank piece of land and rezoning and things like that? That in itself, adds let's say a couple of years to your life cycle, or is your preferred way of buying is that hey, something is already zoned, sort of shovel ready for lack of a better word, and then use a kind of you're on the racing track, so to speak, at that point. What are some of your considerations when you take some of these sites for acquisition?
Depends on the community. I mean, some communities that have a long entitlement cycle,
Mhm.
I want to take some of that risk out. The analogy that I use sometimes, and you see this often in high value markets, where someone has a particular property that's zoned for its current use. It
Mhm.
might be a single family home.
Sure.
But
Mhm.
in the municipal plan overlay, the city's designated that maybe they might approve higher density in the future.
Interesting. Mhm.
Okay.
Mhm.
So then the landowner says, well, I'm going to sell this at a premium because I know that the buyer is going to put, a tower on top of this single family home.
Sure. Mhm.
But they never went through the effort to get the zoning changed.
Sure. Mhm.
So let me ask you the question. If you went to the grocery store and you bought a chicken versus an egg,
Mhm.
are they worth the same?
Right, right. No,
Right?
I totally agree with you. I mean, it throws a lot of variables into it. I mean, of course, on the surface, it looks like, yes, it is. I mean, it has a potential, but sometimes the potential is the potential until you realize it about perhaps.
Right, right. So there's a lot of distortions where people will try and price the egg as a chicken,
Sure.
but it's not a chicken yet, and you don't know if the egg's going to hatch and all of that.
Right. Right.
So, those are some of the risks.
Hmm.
And the reward goes to the folks that do the heavy lifting and do the work.
Sure. Hmm.
It doesn't go to the folks that are just speculators.
Right, 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 right. So, are you saying then, Victor, is that the preferred way perhaps is to maybe acquire something that's already zoned for something so that you kind of eliminate that risk and you're mostly going on with your sort of plans and vision for what you
We
want to
would
do?
prefer to do that, but if I look at, the vast majority of the projects that we have going on right now, almost, I'd say 3/4 of them have a zoning application as part of the process.
Oh, I see. Uh-huh.
Um, I'd rather we didn't have to do that. Now,
Hmm.
sometimes it's not even a zoning change. Sometimes it is within the zoning that's currently on the property, but because of the scale of the project,
Hmm.
you have to do what's called a planned use development,
Sure.
which is
Hmm.
almost equivalent to doing a zoning over the entire project.
Hmm.
And when you do that, it's almost exactly the same process. You go through the same approval process for a planned use development that you pretty much do for zoning.
Sure, sure. Now, coming back to some of the nuts and bolts of the capital aspects of these, Victor, uh, let's start maybe step by step as far as how you would first off structure these deals, or maybe let me take a step back. Like when you're acquiring this, obviously the construction and the end exit is years away. So give us a sense of how you're structuring these deals from a sort of a deal standpoint. That is it something, I mean, I know in the multifamily world how we do it, but from a construction side, what are some of the typical ways of how you do this?
Well, there's two parts to this. I mean, the first is the construction, and then there's the actual, the equity investment and what does that look like from the investor standpoint.
Mhm, mhm.
So typically you're going to have two phases of your financing. The first that governs your construction and then your permanent financing.
Mhm, mhm.
Sometimes you'll get the same lender to do a construction loan that will convert to permanent,
Permanent, correct.
but often they're separated.
Mhm.
We're not huge fans of signing recourse debt, meaning we're not huge fans of signing personal guarantees. And to get non-recourse construction loans is a little bit more difficult.
Mhm, mhm.
Not many lenders will do that.
Mhm.
So sometimes you end up paying a little bit more for that because
Sure.
the lender's taking a bit more risk. It also means that they're going to be not going to be willing to lend at that higher ratio. So they may only lend at 70 or 75% loan to cost.
Sure.
Whereas in the world of permanent financing, you might get a lender that's willing to lend at 75 or 80% loan to value, which is a
Which is a
much higher number,
big difference, right?
right? So we may sometimes, for example, finance the construction using a conventional construction loan, non-recourse construction loan,
Mhm.
at maybe 75% loan to cost, and then we may refinance maybe with a HUD product like a 223F product
Mhm.
or an agency loan like Fannie or Freddie at a much higher ratio, and that's permanent financing, of course, at a much lower rate. We can often, of course, not only repay the original construction loan out of that refi into permanent financing, can often pay back at least a portion, sometimes even all of the equity investment and
Mhm.
do a
Mhm.
full cash out refi when we convert into permanent financing. That is the goal.
Sure, sure.
We want to get the investors their money back and use that refinance as an interim exit so that we get all of our chips off the table and we're still holding a nice brand new quality producing asset that is at a reasonable equity ratio but with no cash tied up in it.
Sure, sure. Now, Victor, as far as structuring the deal, I mean, thank you for clarifying the, sort of the financing part of it. But let's say if we were to involve investors into this deal, what does that look like? Like what sort of pref, if any, or perhaps what sort of split we are offering in
It,
general?
it, I don't want to get into details because we're not here soliciting for anything, and I
Sure, sure.
certainly don't want to be perceived as that.
Right, right.
But what we do is, we'll typically have one class of shares for the deal sponsors,
Mhm.
a separate class of shares for the limited partners that are investing in the project.
Mhm.
We will often put in a preferred return,
Sure.
and that preferred return is there against the invested capital. And so a simple way to think about
Mhm.
that preferred return is I'm going to use a little bit of a different terminology. Imagine for the moment if you had a convertible note, a convertible loan,
Mm-hmm.
where at the beginning of the project, that loan appears like a debt instrument. It's got an interest rate attached to it.
Mm-hmm.
And then on refinance, that loan converts from being a loan to equity.
Mm-hmm. Mm-hmm.
And so now you've got equity, the interest rate disappears, now you've got cash flow. And what that does, it creates a mechanism whereby during your construction phase, during that period where you didn't have income in the project, there was still income flowing back to the investors. They get all or most of their money back on conversion to equity. And then they're still holding their equity position in the deal and getting cash flow for a very maybe small amount of cash left in the deal.
Sure.
So that's typically the structure we like to use. Something along that kind of theme is the way we approach it.
I see. Now, speaking of, you know, like construction of this, Victor, uh, we know that you have a Class A construction that's completely, luxury style decked out with, let's say, granite glass and things like that, right? But, you have the lower set of construction, which could be, perhaps just a modest construction, looks great. It's livable, it's clean, works functionally great, and things like that. So my question to you, Victor, is that when you are analyzing the project and things like that, what sort of factors go into evaluating that, hey, what class of construction you're going to do?
The difference in construction costs between Class A and Class B is only a couple of percentage points.
Interesting.
Because the only thing that varies from one to the next are your finishes. It's a very
Sure,
small percentage.
sure. Couldn't agree.
So, but the difference in rent between Class A and Class B is more than a couple of percentage points, which is
Sure,
why almost everybody that's building today is building Class A,
sure.
because
Makes
it wouldn't
sense.
make sense to build Class B,
Sure. Makes sense.
right?
Makes sense. And I guess I assume that's all dictated by what's happening in the current sort of area around and things like that. If we can support higher Class A, let's stick to Class A. Well, would that be a
Yeah,
correct statement?
yeah, yeah. You want to go into areas where there is the income, the demand to support those rents. Now, if you get into properties that are too expensive, then you can get upside down because you're really competing with folks that might come and rent for you for a time being, but they're ultimately going to buy,
Sure.
right? So if they're going to disappear and go buy their own house in a year, then you've got a high turnover Class A project, and it's one that's probably not going to meet your stated forecast.
Interesting. And now speaking of all this, Victor, I know like in the multifamily sector, we say that there's just so much competition going on as far as what's happening, and just so many buyers and things like that. From a ground up construction standpoint, is it similar, Victor, that you see a lot of competition, or is it more modest as compared to a typical multifamily or self storage deals?
It depends. It depends on the area.
Hmm.
If there's areas where there's very little developable land left, you often see a bit of a feeding frenzy around land. We're
Hmm.
seeing that in a number of submarkets where there's very little industrial land left.
Hmm.
So those few parcels of industrial land are kind of in that auction environment, even though nothing's been built on them yet.
Sure.
So it just depends on the dynamics of that local submarket.
Sure. And any pieces of data or websites or anything you want to share, Victor, that viewers can take advantage of, like, hey, go check this report or perhaps check this website before you look into some of these sites?
What I find is that the majority of the data that's out there in the public domain, most of it tends to be um, very general in nature,
Hmm.
where they talk about the averages, and the averages don't exist in reality.
Sure.
They're just the averages over. It's like saying, what's the average age in America? Well, what's that have to do with you? You know,
Right.
it's not useful.
Sure.
So uh, what I find is that a lot of those reports just are not that helpful,
Sure.
and they don't pertain to your hyper-local situation.
Sure.
You can have a downturn in the economy, but your local economy could be running in the opposite direction,
Very true.
right?
Very
You
true.
think about cities. Let me compare two cities just at random. Let's pick San Francisco and Austin, Texas.
Sure.
San Francisco rents have fallen 25-30%. People have left the city in droves.
Sure.
Austin's attracting a ton of population. A lot of people from the West Coast.
Absolutely. Absolutely. Absolutely.
So is that COVID? Is that like what is that?
Sure.
At the end of the day, the economies are hyperlocal.
True.
Right?
Hyperlocal is the operative word. I think you rightfully said, and I appreciate that comment, Victor, where I think reports give you a general sense, but I think to get the pulse of the market, it's really that hyperlocal, knowing what's exactly going on there. Perhaps maybe brokers are a great source to tell that, hey, such and such companies have moved in, and this is the demand we expect, and things like that. So hyperlocal, getting to know that exact environment is kind of the operative word right there. So
Right.
thank you, Victor. A couple of last quick questions. In your storied career, you have networked with so many folks. I know you are a sort of a featured speaker all the time on various channels and stages and things like that. So my question to you, Victor, is that what are some of the best advice you try to remember all the time that kind of keeps you in check, as you execute your daily activities? What are some of the key pieces that stand out to you?
I would say number one, I tend to focus, I just focus on getting the projects done and getting them staffed. That's probably the number one thing. I focus on saying no to things that are going to be a distraction, and making sure that we've got as many folks in our team engaged and running with big meaty things that need to get done, so that we get these projects over the finish line, get them leased, get them built. It's the process. It's the daily grind of executing the projects. And, we don't take a ton of time to, hold big celebrations. We signed a contract today with the U.S. government for a little over $500,000. We're okay. We haven't even celebrated that. We're not even going to. It's just okay. On to the next thing.
Sure.
So it's really all about execution.
Sure.
And that's really the joy. You've got to love the journey. If you don't love the journey, then don't do it.
Love that. Absolutely.
Yeah.
I think keeping eye on the ball and not getting overexcited, just keep the traction and the friction going, and love the journey. So I appreciate it, Victor. For viewers and listeners, kindly share how they can find you and learn more about your company and everything that you have going on around you.
Well, probably the best way to connect. I'm the host of the Real Estate Espresso podcast. This is a daily show 7 days a week.
Awesome.
Where we talk about literally what's new in the world of real estate investing on a daily basis. And so we've got a large and growing and loyal listener base. We have some amazing guests on the show. On the weekday show, it's just me, 5 minutes. And the weekend edition are interviews with notable people from the world of real estate investing. And so that's an awful lot of fun. It's a great way to connect with me and learn a little bit more about what we're doing. And it's really pure education about what's happening in the world of investing. And if they want to get in touch directly, reach out to me directly at victorjm.com. That's my website, victorjm.com. And thank you for having me.
Awesome. So for viewers and listeners, that's Real Estate Espresso podcast with Victor. Please log in and check him out. I have personally been benefited, and some of the featured stars, you would probably see them on TV and things like that. So it is a great source of information. Thank you, Victor. It is a great episode. I'm personally going to rewind and rewatch. Some of the nuggets that you said are very much priceless. I think I like to always say that when veteran guests who have such experience come on, I think the knowledge is in the sentences, and that you kind of can listen in and break down and reverse engineer what that means and sort of extrapolate to your experience, to your sort of applicable situation. So I appreciate your time. So thank you for coming on. For viewers and listeners, please log on to premiumcashflow.com, where guests like Victor and many others come on, share their valuable experience and advice. So it is a pleasure, and thank you for coming on.
Perfect.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.